Because what I'm seeing right now is absolutely incredible. Incredible. Interest rates super low. Mortgage rates just hit a new low. The 10-year, 0.66. Put that in perspective. What does that mean? That's 10-year treasury. It was over 2% a year ago, and the long-term average is 4.45%. It's 0.66. What does that mean? It means the quest for yield is, I wouldn't say impossible, but it's very difficult to get, to the point where yields across the board are just at record lows. Now, why is this such a huge deal? When you look at the markets, the things that you don't see, you see different stocks, the institutional money with the trillions, the sovereign wealth funds, the big, just the insurance companies that make all these premiums, the best business in the world, right? You pay all the money up front for something that probably is not going to happen. You need to do something with that cash. Their goal is to generate the most money while taking on the least amount of risk. And that was cool. You could do that with different vehicles. But now a lot of this stuff is down a lot. And it's hard to get yields. But in today's market, there's an opportunity that's absolutely huge. It's the biggest opportunity for every single investor. Because when you're looking at dividend-paying stocks, I'm talking about crazy dividend-paying stocks. I'm talking about ones that are growing, that are safe. These are going to be the new Amazons and Microsofts. These are going to be the new growth stocks of the market. As crazy as that sounds. Hey, these are your shot to generate 10% annual returns with these dividends included, while taking on, I don't want to say minimal risk, but much less risk. So you're not talking about generating 200% returns annually, which we provide, and we try to have stocks like this in my Curzio venture portfolio. But that means we're going to have to take a significant amount of risk. And we want to limit that risk by putting 35% stops or whatever. But we want to make sure if we're right, that reward justifies the risk we're taking. That's fine. I'm not talking about that. I'm talking about increasing your overall rate of return while reducing your overall risk, which is the holy grail of investing. As boring as that sounds, it's the holy grail of investing. Imagine you could generate significant returns, 10% plus annually, without taking on that much risk. I know you should all have your portfolios where you want to hit that grand slam. I get it. I'm an investor. I've been in this industry for my entire life. I understand it, and I do that as well with my money. Okay? I put money aside that I invest in gold stocks that got crushed, that are doing absolutely amazing right now. Some of them. You always want to take on that risk, the chance that you could become incredibly wealthy. Millions and millions and millions of dollars you could generate. You always want to take the chip, but I'm talking about the core portfolio, your core portfolio right now. Because the way the market is set up, it's never been this great of opportunity. Let me put this example. You're looking at collateralized debt obligations, CDOs. This is basically just a pooling together of a bunch of loans, which reduces the overall risk. Because you need, if you pool together 100 different loans, yeah, you might have a couple of defaults here and there, but as long as most of them maintain, that keeps it safe compared to just, having one loan and lending out off of that. So that's where CDOs really took off, especially 2005, 6, 7, as banks paid the credit agencies under the table to rate many of these bonds AAA. And you know what? A lot of them deserve those ratings early on. I mean, you talk about prime loans, good loans, even the ones that are mediocre. But then what happened? The greed kicked in. People wanted higher returns, and they were running out of products. They couldn't pool. They needed more loans. Where do you get them? Well, let's go to the shitty market, the subprime loans, which, by the way, everyone thinks subprime loans crashed the market in 2008, 2009. It wasn't subprime. It was the super leveraging of subprime loans, of subprime CDOs by 20x. They're creating synthetic CDOs, which if you have a margin account, I mean, you can't really identify because you're not as leveraged as they are, but you need a 3-4% decline in housing prices. And remember, back then, everyone said, home prices never decline. They never decline. They keep going up. Well, there's a 5-year stretch into 2007 where they usually go up 2 to 3%, and they went up an average of 20% plus annually for 5 straight years. So you know it's going to revert back to the mean. And that's what happened. But you just needed a small decline to crash this entire market. And that's what happened. It sparked an unprecedented sell-off. Market was crashed the world economy. But we're talking trillions of dollars that were in these vehicles. Why? Because the big, crazy money, the sovereign wealths, the pension funds, insurance companies, trillions and trillions of dollars. They need to generate income off this money. And their goal is to generate as much income as possible while taking on as little risk as possible, which is why trillions flowed into those CDOs. Because these money managers, insurance companies, pension funds, the people who are running could justify putting massive amounts of capital into those CEOs because they were rated, hey, they're AAA. You're good, they're rated AAA. Yet they were just getting rated AAA because the credit agencies are getting paid. And if you didn't rate them AAA, then they would go across the street and whatever. You guys should know the story by now. There's a million books written about it. Now, fast forward to today. Why am I bringing up that story? Where are these firms going to find yields that are basically negative after subtracting the rate of inflation? You're looking from 2005, 2007, a 10-year yield of more than 4%. That sounds great. That's a big number. But inflation, CPI, was 4 to 5%. So you're basically losing money, the real rate, which includes inflation, because inflation was higher than the yield that you're generating. So instead of going to 10-year, things like that's what the flood of money went into some of these CDOs. And people were high-fiving each other, making a fortune. Everything was great. But putting money in a 10-year back then meant that you were losing money when accounting for inflation. Now, the past few years, we've been hovering about 1.5%, 2%. Right now, the rate is even lower than that because of COVID. But even at 1.5%, and to put your money in a 10-year at 0.6%, makes a little sense. You know, money market funds, savings accounts, CDs. And right now, there's a massive search for yield. And I'm talking about trillions of dollars searching for a home. And the greatest opportunity right now is dividend-paying stocks. And more important, I'm not talking about buying a Dividend Aristocrats. Be careful with Dividend Aristocrats. I think there's one or two. There's definitely one. I think there might be two or three that have come off that list. I think it's 25 consecutive years of increasing their dividend annually, 25 years plus. Well, with COVID, again, revenue's down tremendously. A lot of companies, I think it's 30% of the S&P 500 is suspended or just cut their dividends, and probably more are coming. But it's not just buying high dividend paying stock. No, it's not that. It's buying stocks that are in the right growth markets that pay a dividend. That's the formula. As providing a level of safety in this market, that's insane. It's an incredible opportunity. You could say it's once in a lifetime because of what COVID created, the Fed spending trillions, get 30% of US GDP, which I cover with Rich, to put a floor under this market. More money is coming. I mean, returns like this are going to be a layup. And stocks like this will continue to run higher and higher, which is you're seeing, take Microsoft and Apple, both of them pay a little bit less than a 1% yield. I think a year ago, it might have been 2%. These stocks have run up tremendously. But now it's you would generate a 2% yield buying growth stocks that have that liquidity, and you have a Fed backstopping the market. Where do you want to invest in? You look at 10-year Treasury market, trillions of dollars. I mean, you're looking at these market caps are well over $1 trillion. I think they're past $1.5 trillion now, pretty close. Liquid. That's what you see in this money coming in. It can come in and out whenever it wants. You're generating more than the 10-year, and you're buying companies that are supported by the Fed. Makes sense, right? I'm not talking about buying the 5% yielders or 4% yields, which will do good in this market, but you have to make sure that these companies are growing. And it's amazing. You're looking at Intel. I remember recommending Intel had a 4% yield. It's 1.7 now because the stock has surged. There's money flowing into it. Oracle, another company doing 1.7. Notice how these technology companies with these Texas Instruments closest to 2-week highs. Cisco at 3%. Broadcom over 4%. Taiwan Semi over 4%. Companies trading at 52-week highs or near that. They're in the right growth markets where money is pouring in and they're paying you a yield. These conditions never existed before, where you could generate great returns while also getting a yield, which are going to result to more than 10% annual returns. And as crazy as that sounds, since the 1950s, the S&P 500 companies have returned on average around 8% when including dividends and compounding it. Here's an opportunity. People say the returns are going to be 1% going forward, 2% a year going forward. All these studies, throw them out the door. They've been totally wrong. Totally wrong. They've been saying that for 10 years. Totally wrong. The market conditions, like I said, you need to adapt. Take what's being given to you. This is being handed to you on a silver platter where you could buy some great names, some great stocks that are growing, and maybe that yield would be 1.5%, 2%. You might say, well, I'm generating. These stocks will soar because that dividend is much, much higher than the yield that you're going to get almost any place else. Plus, you get the opportunity to buy a growth stock, which is being backstopped by trillions, which is being spent by the government. We never had that opportunity before. So where am I going with this? Because I was supposed to launch this. Product, unlimited income, about a month ago, but we pushed it off. COVID, a lot of things going on. Our token as well. But now we're going to launch this product, unlimited income, next week, which is going to be run by Ginia Terranova, who's been an expert in this industry for a long time. Finally, these products are going to be launched. This is something that I listen to you about. Okay, this is what my company is. We want to listen to our customers. So even if the criticisms are frankcurzioresearch.com, that's what makes us a better company. That's why customer service is such a big focus for us, because that's when you know the problems exist right away, and you could end them right away and come up with a plan. You see it. If something's wrong, whether it's simple as a link or something didn't work or whatever, if people are pissed off about something that was written, we see it right away from you, from our customers. That's what this business is about. And across the board, when I say, what newsletter do you want me to start? Almost everyone, I would say more than 80% of those emails, please start an income newsletter. I didn't want to start an income newsletter. I didn't want to start one that's going to give you dividend aristocrats and charge you for that. No, it's not what we're about here. This is going to be different. You're going to see probably lower than expected yield, but companies that are in the right industries, growth industries. And Ginny is one of the best at doing this. This is what she's done for decades. So having her on this product is fantastic. I know a lot of you, if you subscribe to Money Flow Trader, or if you're a Curzio One member, which means you're a member to all of our products, it's a premium membership. This has been in beta version for a couple of months. We look at how work. Now we're going to release to the public. And the best part of this is I'm putting it at a price point because I know so many of you want it. This is something we could charge easily over $1,000, which we call in our industry a back end. This is going to be an incredibly cheap newsletter that every one of you can afford. But that price point is only going to be available to you, podcast listeners. We offer this for you first before we go out to the masses and market these products. Again, we're a business. We want to generate money, but we want to listen to our customers, provide you the best products with the best people on those products. Because at the end of the day, you're listening to us to help you become better investors and to make money. And that's what we've done with this product. It's been carefully crafted. You're going to see lots of cool ideas, preferreds and closed-end bond funds, closed-end funds, things that provide yield, but also the opportunity to buy growth stocks that are paying 1-2% yields, where a lot of people out there may be looking for 5-6% yields. Okay, you could have bought IBM, which I love. I like IBM. But imagine buying Microsoft 2% yield a couple of years ago, and look how much you're up in the stock, because it's growing much, much faster because they're in the right growth markets. Just like Apple. Apple's growing as well, tremendously. And these are incredibly liquid stocks where you're seeing tons of money flow into them. You're going to continue to see that trend as long as interest rates are low, because buying those dividend-paying stocks in these growth markets, I cannot think of one place better to put your money if you're an insurance company, if you're a pension fund, sovereign wealth. And that's why you're seeing the market caps of some of these large companies explode higher, even though the fundamentals may not support where they are. It's because they're liquid and people they die for yield. There's trillions searching for it. And you're going to see that money filter down to so many other stocks. This is going to be a new growth area, and you don't have to take on a considerable amount of risk to generate very, very good returns going forward. But you have to start now. We're launching this product next week. Any questions or comments about it? frankcurzioresearch.com. We're really proud to launch this. We haven't launched a product in let's say, a year. So we're always careful. We always ask our customers what they want. I know you guys really want this, and I know that you're going to be really happy with this product. I love Ginia, and we'll talk more about it. But if you're not on our email list, send me an email at frankcurzioresearch.com. I'll make sure you'll get the promotion. Please sign up to the link that we're sending you. Do not sign up just going directly to the website, or we'll provide a link for you. But it's going to be a special deal available only to Curzio Research podcast listeners and to our subscribers.